These last couple of months have arguably been the worst for the cruise line industry since the sinking of the Titanic. The industry has been plagued by terrible news of ships coming back with literally a boatload of infected COVID-19 patients, and in the worst case, we've even seen some of those patients die. Now, a great example of that was Carnival Cruise's Diamond Princess ship, which came back with 712 confirmed COVID-19 cases and led to a total of 13 deaths. Now, this awful incident led to the decimation of cruise line stocks, and many are wondering whether cruise lines are ever going to be able to make a comeback and if the industry is going to continue on the growth trend that it's seen over the last 30 years. And that's why in this video, I'm going to be going over whether you should be investing in the cruise industry in 2020. And the way I'm going to do that is by comparing the valuation of these cruise lines before the COVID-19 crisis to their valuations after the COVID-19 crisis. Now, if for some reason you're not interested in my analysis, then you can skip all the way to the end where I'm going to be comparing the return potentials of all three of these companies. How's it going, guys? My name is Aaron. I'm a value investor and trader. Welcome back to my channel. If you enjoyed this video, please hit the like and subscribe button. I put around 20 to 30 hours of work into each of these videos so that I can bring you guys the best analysis to make an informed investment decision. Now, as always, I'm not a financial advisor. These videos are for entertainment purposes only. However, at the same time, I do hope that you guys find some value in them, and at the same time that you do enjoy them. So with that, let's get right into it. The first thing we need to look at is the growth trend for the industry. Now, we've seen from the 1990s, there's been very stable and in some cases exponential growth to the cruise line industry. Now, I personally am not a cruiser. I've never been on one myself. However, after conducting a good amount of research, I've realized that there's four main reasons why people love cruises. The first is that they're very affordable. The average cost of a night on a cruise ship is $150. Now, when you compare that to a hotel, which is around $96, and you factor in the fact that cruises are all inclusive, you can see why people love cruises so much. Second, they're able to visit multiple destinations in one trip. Now, if you were to plan out a vacation where you're visiting multiple locations around the world, it would take a lot of time and it would be very expensive. However, for the cost of $150 a night, you're able to visit multiple historic locations around the world and have a great time doing it with all of your friends on that cruise ship. Third, there's no planning required. All you have to do is pay for your ticket, load up your bags, and get on the ship. This makes it very easy to bring on new customers and to keep people coming back because a lot of people are drawn to the convenience of these cruise vacations. And fourth, cruise vacations are very unique experiences. Where else are you able to float around on the ocean, visit multiple locations while hanging out with your family and friends, all for the cost of $150 a night? And while the recent developments with COVID-19 have very significantly impacted the reputation of the cruise industry, in the long term, it's hard to imagine this form of vacationing being replaced by something else. And now, to understand where the growth in the industry is coming from, I've broken it down by country. So let's take a look at the compound annual growth rate so that we know how fast this industry is growing compared to the general market. The global cruise industry has a compound annual growth rate over these last 5 years of 6.87%. Now, North America itself has seen a 4.37% in passenger growth. The EU has seen only 3.48%, while the Asia Pacific market has an astounding compound annual growth rate of almost 24%. This is something that's very important because it's going to be a very lucrative opportunity for these cruise lines to be able to capture that Asian Pacific market, because as their economies grow and their populations become more wealthy, naturally a lot of them want to travel more. And given what we looked at before on why cruise lines are so attractive, you're going to see a big boom in terms of the passenger growth for these cruise industries. Now, finally, let's take a look at the competitive structure of the industry. Now, the industry is structured as an oligopoly, and the reason why is because the fixed costs for this industry are so high that it's very hard for new competitors to come into the market. And in addition to that, it's very hard to coordinate with international ports when your cruise ship is going to be able to dock at a port. So for that reason, these companies that got into the industry early were able to leverage those connections that they had with international ports and allow them to grow their fleet while maintaining the economies of scale across their business. So the top three companies that control most of the market share in this industry are Carnival Cruise Lines, Royal Caribbean Cruises, and Norwegian Cruise Lines. Now, this makes the investment decision for you much easier because you don't need to be looking at 10 to 20 companies that are all competing in the same industry. You can narrow it down to just three. And that's what we're going to be doing in this video. We're going to be taking a look at the valuation of these cruise lines before the COVID-19 crisis, and then we're going to compare it to the valuation after the COVID-19 crisis. So let's get right into it with the first stock that we're going to look at, which is Carnival Cruise Lines. Now, you can see Carnival Cruise throughout its history has seen some pretty drastic drops. During the 2001 tech bubble, it fell 63%. During the 2008 recession, 65%. However, this recent crash dwarfs all of that. And that's not very surprising given all the negative press that we've seen specifically about cruise lines, which has led the stock price to crash 85%. And you can see down here that their yield popped up all the way to 20%. Now, many people take this as a great investment opportunity. And for full transparency, you should know that I do own Carnival Cruise Lines at $13. This doesn't mean that I'm going to be recommending it purely because I am invested in the stock. In fact, I think that the Carnival Cruise Lines doesn't make the best long-term investment, and you're going to see why. So let's take a look at their cruise lines. Everybody knows the Carnival Cruise Line. People think of it as the party cruise line, but they have 9 overall cruise lines that operate all around the world. You can see that they have some cruise lines that are dedicated to just Italy, like their Costa line, or they have some like Ida, which is purely a German experience. So they have cruise lines that operate all around the world, which is able to bring in demand from countries around the world. Now moving on, let's take a look at their revenues and operating profits. Now you can see that their revenues are pretty stable. During the 2008 recession, you can see that their revenues didn't even drop below their 2007 levels. And the reason for this is probably because of how affordable they are. The demand is probably fairly stable regardless of what's going on with the economy. However, you saw that revenues stagnated from 2011 to 2015. And the reason for that is because Carnival Cruise has actually been slowly losing their market share to Royal Caribbean Cruises and Norwegian Cruise Lines. Carnival Cruises have a much larger market share of the entire international cruise market. However, Royal Caribbean and Norwegian Cruise Lines has been slowly taking away some of their market share. And they only started seeing an increase in the revenues again in 2015 to 2019, in which the entire cruise industry actually saw pretty tremendous growth. Now, if you look at their operating profit, it's much more variable than their revenues. And a big reason why you're seeing the operating profit dip during that period where the revenues flatline is because the cost of their inputs likely went up while the revenue stayed flat. So their operating profit went down. However, after the revenue started to climb up again, you see that their operating profit rose dramatically. Now, taking a look at their revenues by geography, we see that North America is by far their largest customer segment. And you can see that Australia and Asia are actually are a very small portion of their revenues. However, this is actually a great sign because, as we saw before, the Australia-Asia market is growing extremely rapidly. So this is going to provide a great opportunity for Carnival Cruise to see growth in their revenues. Now, if you look at their average operating profit over the last 12 years, they've maintained 14.56%, which is very solid. And the reason why they have such high operating profits is because the industry is structured as an oligopoly, which gives them the ability to produce above average operating profits. Now, if you look at the compound annual growth rate of the revenue, it's only 3.98%. And if you adjust for inflation of around 2%, you're only seeing real growth of around 2%, which is around that of GDP, which isn't great. And even worse, if you look at the compound annual growth rate of their operating profit, it's at 1.55%. After adjusting for inflation, you're actually seeing negative real growth in their operating profit. So looking at this makes Carnival Cruise not the greatest long-term investment. And this is why my strategy for buying Carnival Cruises wasn't to purchase them for a long-term investment, but was actually so that I could hold them until they revert back to its intrinsic value. So now moving on, let's take a look at what happened to their capital structure prior to COVID-19 and after COVID-19. So before COVID-19, they had an average capital structure of 29%, which is perfect and even maybe a little bit low given how stable their business is. And they had an interest coverage of 14.7, which is amazing, which means that they had no risk of bankruptcy before this crisis occurred. However, after COVID-19, you see that their new capital structure shot all the way up to 45% debt. Now, what they did was they had to resort to the capital markets to raise a bunch of debt so that they could better their liquidity position. Now, what they did is they raised $5.95 billion in cash and $500 million in equity. Now, out of that $5.95 billion of debt, $4 billion were senior unsecured notes carrying an 11.5% coupon, which means that that's going to add around $400 million in interest expense for the company in the following years. $1.95 billion of that was convertible and carried a coupon rate of 5.75%, which is going to add somewhere around $100 million in interest expense to the company moving into the future. This means that the company is now going to be paying an additional $500 million in interest every single year, which lowers their interest coverage all the way down to 4.34. And now when I was calculating the interest coverage, I was using the normalized operating profit figure and not the EBIT from last year. So these might be a little bit lower, but I like to err on the side of caution. So for that reason, I wanted to make sure that I was using the most reasonable estimate for the interest coverage. Now, an interest coverage of 4.34 times is actually still solid. You want to make sure that a company you're investing in has an interest coverage above 3. Otherwise, they're going to be open to bankruptcy risk. And additionally, they raised $500 million in equity through selling 62.5 million shares at $8 a share. And finally, their retained earnings took a $780 million hit due to the recent loss in this quarter. And that's what led me to the new capital structure of 45%. Now, this is a little bit on the high side. However, it's still reasonable given how stable the company is. And given how well management has dealt with this situation, it's likely that they're going to be able to meet their liquidity needs and get out of the situation. However, if you are making a long-term investment in these stocks, you should be expecting a relatively large drop in terms of their net income, since they're going to be paying a lot more in interest expense. So now let's take a look at their valuation pre-COVID-19. Taking a look here first at the return on invested capital of 4.82%. That's less than the weighted average cost of capital of 5.9%. And you're going to see that with all three companies that we're looking at today. And the reason why is because the industry has likely exceeded capacity, and for that reason, they're not able to generate returns equal to the weighted average cost of capital. Now, after running the EPV NAV analysis, I got an intrinsic value per share of $51. And after applying a 33% margin of safety, an entry price of $34.35. Now, if you want to know how I arrive at this intrinsic value, I have a series of 3 videos on my channel, which I suggest you guys check out, and I go in depth over how I use these models in order to find the intrinsic value of a stock. Now, moving on, let's look at their valuation after COVID-19. Now, we see that with their new capital structure, this has decreased their intrinsic value from $51 per share all the way down to $37 per share. And after applying a margin of safety of 33%, you get an entry price of $25.37. And given Carnival Cruises is currently trading somewhere around $15 to $16 per share, this still gives you a very solid entry, and you can generate over 100% returns just for the ride back to the implied share price. Now, let's move on to the second stock, which is Royal Caribbean Cruises. Now, different than Carnival Cruises, Royal Caribbean has actually fallen this much in the past. During the 2001 tech bubble, they fell 85%. During the 2008 recession, they fell 87%. And during this current COVID-19 situation, they've fallen 85% as well. Now, Royal Caribbean is most known for its Caribbean vacations, not a big surprise there. However, they still do offer vacations all around the world as they are an international cruise line. Now, let's take a look at their revenues and operating profits. And you can see that Royal Caribbean has actually seen a dramatic improvement in their operating profit. And the reason why is because Royal Caribbean has been able to take some market share away from Carnival Cruises. So they've been able to grow their revenues at the same time their operating profit has improved during that period. Now, over the last 12 years, they've had an average operating profit of 13.7%. The compound annual growth rate of their revenues has been 5.3%, while the compound annual growth rate of the operating profit has even further exceeded that at 7.9%. Now, this is very positive for making a long-term investment in Royal Caribbean. And you should also know, for transparency reasons, that I do have a position on Royal Caribbean at $30 a share. And again, I'm not planning on having a long-term investment in these companies. I'm purely expecting to ride them back to their intrinsic value. Now, finally, if we take a look at their revenues by destination, we see that their North American revenues dwarf any of their other revenues. However, this still provides them with a great growth opportunity from the Asian Pacific market. And it's something to look out for, not just for Royal Caribbean, but for all three stocks. Now, moving forward, let's look at their capital structure. And this is the reason why I'm not going to be a long-term investor in Royal Caribbean, because I believe that their average capital structure of 50% over the last 12 years is far too high for a company given how large their asset base is and how high their fixed costs are. And even before this COVID-19 crisis, they had an interest coverage of 3.64 times, which is cutting it awfully close to that 3x mark that you want to see a company have. Now, after COVID-19, Royal Caribbean had to resort to the capital markets similar to Carnival Cruises. However, they raised $4 billion in debt, and they didn't raise any equity. Now, $1 billion of that were senior secured notes at 10.8%, while 2.32 were convertible at 11.5%, and they also drew from their line of credit around $680 million. Now, this adds around $300 million in interest expense for the company moving into the future and lowers their interest coverage all the way down to 2.44 times, which is now in that bankruptcy risk area, which is why I'm not going to be planning on holding these guys long term, and I'm just going to be riding them back to their intrinsic value. Now, let's take a look at their valuation. So similar to Carnival Cruises, you'll see that their return on invested capital is less than the weighted average cost of capital. And they actually have a higher weighted average cost of capital given the higher debt load that the company has had in the past, which makes the equity risk premium a little bit higher. And that's why you're seeing a higher value of the weighted average cost of capital for Royal Caribbean. Now, the intrinsic value per share for Royal Caribbean before the COVID-19 crisis was $80.68. And after COVID-19, we see that their new intrinsic value is $75.17 per share, which is a relatively small decrease. And you have a safe entry price of $50. And today it actually is trading above that, so I wouldn't be entering anytime soon. But if you see the stock price fall below $50 per share, you know that you have a reasonable margin of safety in terms of entering the stock. Now, finally, let's take a look at Norwegian Cruise Lines. Now, Norwegian Cruise Lines is the newest company out of all three that we're looking at today. And they actually fell the most dramatically at 88%, which you can see right here. And similar to Carnival Cruises and Royal Caribbean, they are also an international cruise line. Now you can take a look. These are the locations that they travel to around the world. And you can see that they actually say that they're Caribbean's leading cruise line, which I don't think is true, seeing as they only have 15% market share. But I'll leave that up to their marketing team. Moving on, taking a look at their revenues and operating profit, we see that they've actually had the most dramatic increase in terms of their revenues and operating profit. Their average operating profit is the highest of all three at 17.15%. The compound annual growth rate of their revenues is 14.2%, and their operating profit grew at 17.8%. Now, these numbers are very impressive, and something that might be giving Norwegian an advantage over Carnival and Royal Caribbean is that they actually don't provide an itinerary to their passengers, and this might be the reason why they've been able to carve out a competitive advantage against the other two. We can see that similar to the others, most of their revenues are coming from North America and a very small portion coming from Asia Pacific, in which you should be paying attention to that to see if that's growing as fast as the Asia Pacific market is, because you want to make sure that the companies you're investing in are going to be capturing a lot of the growth in that market. Moving forward, they have the worst capital structure of all three stocks, which is why I am not invested at all in Norwegian Cruise Lines. Before this, they had an average capital structure of 56%, an interest coverage of 4.11. However, after this, they didn't turn to the public capital markets. Mostly they turned to the private capital markets. So if you look at the structure of some of their debt deals, they're pretty unique and difficult to understand. However, here you'll see a great summary of the capital that they raised in order to meet their liquidity needs. They raised $1.9 billion in debt, and they also raised $443 million in equity financing. However, their retained earnings took a $1.8 billion hit this last quarter, so you're seeing their new capital structure at 63.8%, which, similar to Royal Caribbean, is very high and is the reason why I'm not holding Royal Caribbean or Norwegian Cruise Lines long term. And you see that their interest coverage is still 3.64 times, which is above that 3 times mark that we want to make sure that the companies we're investing in have. Next, their valuation prior to COVID-19. You see that their return on invested capital, similar to the other two, is less than the weighted average cost of capital. And after doing the EPV/NAV analysis, they have an intrinsic value per share at $41. Next, their valuation after COVID-19 took about a 25% hit as their intrinsic value fell from $41 per share to $31 per share. Now, after applying a 33% margin of safety, you get a safe entry price of $20 per share. Now, as promised, here is a return potential for all three companies, so you can make your final decision. Looking at Carnival Cruise Lines, we have a return potential of 120% from its current share price. Royal Caribbean Cruises a 33% return potential, and Norwegian Cruise Lines with a 75% return potential. Now, looking just at the return potentials alone, Carnival Cruise Lines might look the best, but if your analysis might lead you another direction, then by all means, maybe Royal Caribbean is the best decision for you because you want to hold the stock long term. Or maybe Norwegian Cruise Lines is the best decision for you because they've had the highest growth out of all three companies. So each three of these companies has some reason why you might want to invest in them. Carnival Cruise has the largest market share. Royal Caribbean is focused on the Caribbean market, which is the most popular cruise destination. And Norwegian Cruise Lines has even the most rapid growth. So now I hope that you guys have found all this analysis helpful, and I hope this is going to help you guys make an informed decision. Again, I'm not a financial advisor. This video is purely for your entertainment purposes, but I hope you guys found this helpful, and I look forward to seeing you guys in my next video. Have a great week.